Hi, wanted to welcome Catherine Avery, who is joining us today. I'm super excited to talk to Catherine. We always have great conversations. Welcome.
Hi, Leah. It's great to be here again.
There are several things that I think are relevant to talk about, especially this week. One are kind of the violent rotations that we're getting in the market. And really, we've seen this since last November. I think a perfect example of it was on Monday. At one point, Monday, the NASDAQ was up 1%. We got some negative news about the Middle East. And obviously, we had the SpaceX IPO this week. The NASDAQ was down 4% intraday. And then it rallied back a bit, still closed down for the day. But if you look at the Russell 1000 value, it was actually up 0.4%, almost 0.5%. So the volatility is quite impressive. And I'm just kind of curious how you're thinking about this environment and what you're doing from an investing perspective.
Yeah, there's definitely been a lot of zigging and zagging that's been going on in this market. And I was looking at the stocks that had done well just for this quarter so far. So if you looked at where technology was at the end of March, the end of the first quarter, it was at a trough. And all of a sudden, you saw this massive rotation into the tech companies. And believe it or not, a lot of the tech companies, just from that March 30th date up until now, are up around 50%. That's a huge move. So we really can't complain and say that, oh my gosh, the NASDAQ is correcting. Well, yes, it kind of needs to correct a little bit before it goes back up again. But we are definitely glad that we do have other names in the portfolio and other sectors so that when something is zagging, we can zig someplace else, right? So we talked about a week ago how we did a rebalance in the portfolio. We trimmed our positions in technology and then rotated, I shouldn't say rotate because we already own these names, but then added back into healthcare, communication services, financials. And all of a sudden we start to see that now those names are starting to participate in the market. So keeping that broad diversification in the portfolio is really what's key to getting through a lot of this sector volatility that we've been seeing. Or I should say rotation. It is volatility, and sometimes it doesn't always feel so great, but it's more of a rotation, I would say.
Yeah, and I think you're right. I think what's most important in this environment, if you're managing assets, is really discipline. So I kind of saw, I obviously run a thematic strategy. I had technology stocks that hit their price targets, and again, you saw these just tremendous moves. But when you think about what's going on and what industries are well positioned moving forward, where cash flow and earnings should be increasing. Yeah, I mean, it's some of these other sectors that just you haven't seen quite the participation. And these rotations, I think, provide great entry points. When the correlations are lower, it's much better.
Yeah, exactly. We came out with our communication services piece today, talking about the names that we own in that sector. And just, really boring names like Omnicom and Verizon, and how a lot of the earnings growth going forward is really being derived around that whole AI trade. Whether it's, advertising moving more towards the media space and, people being able to react more quickly and more effectively to where the eyeballs are going for cost-effective advertising, or on the Verizon side where you have this thing called convergence, where you have this bundling of apps from all the different networks all coming into one area, and how that's going to benefit that sector as well. So there's a lot of interesting things going on out there above and beyond what we would just call the general tech sector.
Yeah, and by the way, I love your marketing, your reports and updates. They're just very well written. They're always really informational. But yeah, I agree with you. I met with a researcher in the medical community the other day, and she was saying she happened to be doing research for liver transplants and trying to make livers more healthy. Yeah. And she was talking about just with some of the advancements, and you haven't really seen this materialize in earnings yet. But she used to be able to, she was talking about doing 40 million computations to see whether or not some drugs were effective for the trial that she was doing. And she said she was able to do that in 4 months. And she said, 2 years ago, it would have taken 3 to 4 years to go through that. So I think it's just fascinating. And we haven't seen earnings necessarily start improving for some of these companies, but you can see that runway materializing.
There's a huge runway out there. I just took a look before at what the earnings estimates were for the S&P 500 at the end of December. And they were at $308 a share. Do you know where they are today? $335 a share.
Yeah.
I mean, when was the last time we ever saw anything like that? That's a 10% increase. Just
in a short period of time.
Just in a very short period of time. And the valuation on the market has come in, and the PE to growth ratio has come down. So it's all being driven by earnings. So it's really hard to even say, well, okay, the market's done X, Y, Z. It's getting a little scary here. I mean, because that was really the thought at the end of December. But we are really getting that earnings growth coming into the market, which is great. So I know it's a little scary out there sometimes, but I think we have a lot of good things ahead of us.
Oh, I agree. And you mentioned things we have not seen in the past or have not seen before. So let's talk a little bit. We've touched base on innovation, and innovation is definitely something that we're seeing materialize across the economy and the market. But with innovation comes destruction and comes sell-offs and opportunities. And the big thing that we have going on this week is obviously the SpaceX IPO on Friday. And I think SpaceX is really interesting for multiple reasons. One is just the size. So if you go back and look at the average IPO from 2023 through 2025, it was between 165 million and 245 million was the average IPO size. And then we've had 3 large IPOs in history. We had Meta at 16 billion. We had Alibaba at 25 billion. And then we had Saudi Aramco at 29 billion. And we have SpaceX coming public at roughly 75 billion. And that's for 5% of the company. I mean, this is a company has a market cap, an estimated market cap of 1.75 to 1.8 trillion. So this is a huge amount of liquidity that's coming to the market. And that's what I think is kind of interesting. Obviously, S&P has said they're going to wait a year before they decide whether or not to put SpaceX in the S&P 500 or in the S&P indices. And if it were to go in the S&P 500, it might end up being the largest component, which is fascinating. But you do have these other indices that are adding it in pretty quickly. And in order to add, if you're an index, in order to add something new, you've got to sell, you've got to liquidate. You don't actually have cash. And so you've seen a tremendous amount of selling in different areas. And if you kind of look at it, it's really in the crypto, high volatile, more volatile assets, which would make sense consistent with kind of where SpaceX would be positioned. But I'm kind of curious what your thoughts are in general about kind of these new things that we see happening, whether it's innovation, something like the SpaceX IPO and the opportunities they present. How are you kind of looking at situations like that?
Yeah, well, I think they can be a little unnerving in some ways because, I think a little bit of the rotation that we're seeing is probably due to this IPO. But the good thing about what you and I both do is that we don't own indexes, we don't own markets, we own individual companies. And I think that's really important for people to understand. So we are not forced to sell anything if we feel that the long-term story is still there for something that we own. So we can kind of side vent a lot of that. I would say there's a lot of emotion, caught up in this as well. So for us, I mean, I think we're in a better spot to be able to control what we do instead of being controlled and just dictated by an overall market.
Yeah, it's It's fascinating. Again, to me, it kind of gets into the, it is a lower correlation environment, which is great. So when you see the big sell-offs, and if it's a stock in the tech industry that you think is attractive, you can either repurchase positions or add to positions. And I kind of mentioned the SpaceX just because it's so timely right now. But you've kind of seen the whole innovation and destruction around software, right? The opportunities that were presented with a big sell-off in software stocks back in February. But I think we're going to continue to have examples like this.
Oh, absolutely. I mean, because remember, we're also going to have Anthropic and OpenAI in October and November. So this is completely not over yet. But I agree with you. I think both you and I added Microsoft to our portfolios at a very timely, place for the stocks. So, we trimmed, and now, you know what? If it comes back down again and goes below our, target allocation price, then we'll go back in and we'll buy some more at a lower price. So, we've got that flexibility. And again, that's why I say you and I are in pretty good positions, not owning the markets and owning individual stocks.
Yeah, it's interesting if obviously all eyes are going to be on how SpaceX goes, but if OpenAI and Anthropic both do end up going public this year, I was reading it was going to equate to about 170 million in shares, in new traded shares, and the market trades on average 600 to 700 million a day. So again, I think we're going to have these kind of disruption periods as we're digesting these big IPOs, which is just, I think it's just interesting.
Yes.
So speaking of, so we're talking about some of the exciting things happening, and as you mentioned, we've seen a sell-off we had seen a sell-off in the NASDAQ. We've seen a sell-off in some of the chip companies, some of the leaders. On average, about every 18 months, we do have a correction as defined by a 10% sell-off. We saw a really quick sell-off when the tariffs were announced last April, but it's really been a while since we've seen a pretty serious pullback. And so and I never want to predict that to happen, especially in an environment where corporate earnings are going up. But if we were to get into a sell-off, I'd love to know kind of how your portfolio is positioned and talk about how you think about risk from that perspective.
Right. Well, again, we have a 3% dividend yield on the portfolio. So the dividend yield in and of itself will act as some sort of a floor against the downside. So we're protected at least 3% in that case. And I think we, considering the fact that we're pretty well diversified across the portfolio, I think we'll do okay. Especially relatively, we'll do fine. So, clients will still have cash coming into the portfolios. It's kind of hard to figure out, what that sell-off would really, really look like. My thought is that we would probably have to have some extreme black swan event for that really to happen. And we probably should have a correction. But I think because in the broader markets, not in our portfolios, but in the broader markets, tech is 30% of the S&P 500. Tech correcting is almost like a correction in the market, so to speak. So.
Yeah, and I think tech plus communications is 40%, right? Because I think people don't think about Google and Meta or communication stocks.
That's right. That's very true. Exactly. I have to remember that they're in that sector. Yes. Yeah.
Is there any, out of curiosity, there are definitely I missed some of the semiconductor stocks. There's some that I just didn't purchase early on, and I would love a pullback in order for to add them to the portfolio. Is there a particular area that if valuations got attractive that you would look to add, or a particular sector or industry?
Right now, I think we've been looking at things that are on a more of a bottoms up, for particular names. I still think that the industrials is a place that we would look for ideas, but we're waiting for valuations to come in there. They're definitely extended, and they're not, for their price, we're just not getting good enough earnings growth yet. So that's an area we would pretty much look at, I think. I'm trying to think of other areas. There are some tech stocks that we would like to own at a little bit of a cheaper price, and we've been watching in that sector as well. The semiconductors, For us, we're kind of limited with the dividend. So it's kind of slim pickings for us. Intel doesn't pay a dividend. Texas Instruments is like astronomically expensive. We've owned that in the past. So we own Qualcomm in the portfolio, so that was a recent purchase for us this year. So I think that's about it. It's hard. It's kind of hard to say. I mean, we're pretty much where we want to be healthcare wise. We're overweighted energy.
That's obviously been a decision that's paid off nicely this year.
Yeah. Yeah. And I think we plan on keeping it there for some time.
Well, there's never enough time, Catherine. I feel like we could talk for an hour.
Yeah.
Thank you so much, and we'll chat again very soon.
All right. Sounds great.